guys, I'm Neil, and today we are going to be talking about financial leverage. Now, what do you mean by financial leverage? Leverage means how much debt does the company hold, or how much loan has the company taken. Now, why would any company take a loan? Let's say that you are the CEO of a firm and you have one factory right now in place, and you want to open 100 more factories to expand your business all across the world. Now, how will you do this? You have two ways, right? You can either raise equity, so you can do an IPO and raise equity shares and sell a percentage of your firm to other people. So they will be owning a part of your business. But if you do not want to give up ownership of your business and you want to raise funds, the second alternative is debt or leverage. So you can take a loan. This can be from a bank or you can issue corporate bond. So there are other ways how you can raise leverage. Okay, so now that we understood what intrinsically leverage means, let us understand what implications does it have. So do you want to invest in a firm that has high leverage or do you want to invest in a firm that has low leverage? Now, I've broken things down to a very simplistic point of view, but obviously we would not just look at leverage as one factor, but at several different things, and leverage would be one of those things. So the reason I'm making this video is because I used to think of leverage in one particular way, and I found a research report that is completely counterintuitive, and they've proven the exact opposite of what I used to believe. There are a lot of financial ratios and a lot of financial topics that you think have a certain impact on your profit and loss balance sheet or on the share price. But when you actually go back and backtest them, it might have a completely different outcome that you would have never expected. And this happened to me just a few days back. Okay, so according to you, just sit back, pause the video, think for 2 minutes. What impact should leverage have on your profit and loss? So, what a lot of CEOs and the members of the board often say is that we need to maximize the shareholders' return. So, there are some existing shareholders who own the business. Now, the CEO might say that, hey, I need to improve the returns for you. So, if I'm improving the returns for you, I need to take a loan from a bank and expand the business, which is in your best interest. Now, we are going to look into this research report if it truly is in your best interest or not. So, first of all, a small disclosure. This research report was written for US stocks. So, it's not tested for Indian stocks. So, the research report is called Does Financial Leverage Make Stocks Riskier? Part 2. It's written by Nicholas. All right. So, in the first chart that you guys can see on the screen right now, you can see that how the leverage across sectors have changed throughout the years. Now, instead of taking the total loan that these firms have taken, or the debt or the leverage that these stocks have taken, he has taken three ratios that represent that. The three ratios that he has taken are debt to equity, debt to EBITDA, and debt to assets. Now, if you are new to finance and you find these three names a bit daunting, don't be afraid. Just think of it in a way that these three basically mean how much loan the firm has taken. That's a very simplistic way of putting things across. But even when I was new to finance, I was a bit afraid of such ratios. But please do search for what do these ratios mean and what impact do they usually have. Okay, now that you guys have understood uh, what this chart is basically trying to represent, it's basically trying to show that if the net leverage across all sectors on an average since 1980 has increased. All right, so looking at the chart of volatility, we can see that for the high debt to equity, the annualized volatility is higher than the one for low debt to equity, and a similar trend across all the three ratios you can see that he has taken on a sector neutral basis. So now I can say that stocks that have a high leverage or who have a high amount of loan on their books usually will have on a sector neutral basis a high amount of volatility. So if you want to follow a low risk anomaly, uh, you should hold on to low volatile stocks. I made a video on that earlier. You guys can check that out. So what we've established till now is that stocks who have a high leverage usually are more volatile. So they are more risky in both sense that the stock price moves a lot, they are very volatile, as well as they have more loan on their books of accounts. So if high risk means high returns, if the investor is taking more risk by investing in such a firm whose stock price is very volatile, they have a higher amount of loan on their books of accounts, they should get a higher return, right? But this chart proves the opposite. And I'll quote Mr. Nicholas here. Given that we have now established a more intuitive relationship between leverage and risk, we can now turn to the question if investors are rewarded by higher returns for accepting higher risk. Interestingly, neither on a cross sector nor on a sector neutral basis was this the case. Corporate managers and investors frequently argue that balance sheet should be leveraged for boosting shareholders' returns, but this is not supported by this analysis. What we infer from this is that this is a very counterintuitive research report for me and for a lot of people, I'm sure that higher leverage, which means higher risk, which is also, according to this report, highly volatile, gives you a lower return than stocks that have less leverage. So, how can you use this information from this video into your everyday life or by reading a equity research report? The next time you're looking at a stock, your perspective on leverage or how much debt the firm has taken would have changed. You might like to see that with respect to the other firms in that sector, how leveraged is it? Now, that's the most important thing. With it only for that sector, you should see it. And if it is lower leveraged, you should give more emphasis to that particular firm. But this research report is for US stocks. So we can't blindly assume that for Indian stocks also that will be the same. If you guys have any further doubts, feel free to ask me in the comment section below. And if you enjoyed this video, please do like, subscribe, and hit that bell icon so you can be updated whenever a new video is released. Thank you.